The world's economy is sending out some pretty serious warning signals. So today, we're going to decode what they mean and really explore the growing risk of a global recession in 2026.
It's the question on everyone's mind, isn't it? After years of economic shocks and these really bumpy recoveries, you have to wonder, are we heading for yet another global downturn?
And the projections? Well, they're telling a pretty clear story. Now, while the global economy is still growing, the pace is definitely slowing down. This trend line you see for global GDP is pointing downwards, and that signals a real loss of momentum as we get closer to 2026.
And let's be clear, this isn't just a minor dip we're talking about. We're looking at signals that suggest a big, synchronized global event where all the major economies could slow down together.
But before we jump into all of the evidence, let's just quickly get on the same page about what we mean by a global recession. It's a term you hear thrown around a lot, but what does it actually entail?
So, a national recession is usually defined as 2 quarters of negative GDP growth, right? But a global recession, that's a different beast. It's a widespread slowdown that happens across the world's biggest economies, all at the same time. And this leads to a fall in global per capita GDP, which is basically the average income per person on the entire planet.
And look, these kinds of events, as disruptive as they are, they're not exactly unprecedented. The modern economy has faced several major global recessions. Each one was triggered by something different, from the oil crisis back in the 70s to the pandemic just a few years ago. Understanding this history really helps us put the risks we're facing today into context.
Okay, so what is the evidence for a downturn in 2026? Let's break down 3 key warning signs that economists are watching very, very closely.
First up, interest rates. After a really long time of what you could call easy money, central banks slammed on the brakes and hiked rates to fight inflation. And that makes everything, mortgages, car loans, business expansions, way more expensive. And the thing is, those higher rates are sticking around.
This chart really puts it all in perspective. Just compare the rates in 2019 to what's projected for 2025. Even if rates do come down a little bit, money is just not as cheap as it used to be. And that acts like a handbrake on the whole economy, slowing everything down, from how much businesses expand to what consumers are spending.
And this leads us right to our second warning sign, the sheer mountain of global debt. Because you see, higher interest rates are especially dangerous when debt levels are already at historic highs.
This table right here shows you the scale of the problem. Across the board, the US, China, the Eurozone, the debt-to-GDP ratio has just ballooned since 2019. That's a country's debt compared to its economic output. And in a high-interest rate world, just paying the interest on all this debt takes money away from everything else and makes the whole financial system that much more fragile.
The third big warning sign is that the world's main economic engines, we're talking the US, China, and Europe, they're all kind of sputtering at the same time. And when they slow down, global trade, which is the system that connects them all, gets weaker too.
And what this chart shows is that there's no single region out there that's really poised to pick up the slack. Advanced economies are wrestling with high interest rates, China's dealing with its own internal economic issues, and emerging markets are sort of caught in the middle. When all the main players are struggling, well, that's a recipe for a global slowdown.
Okay, so that's the big picture economic data. But what are the financial markets telling us? The people who are always trying to predict what's coming next?
Well, the markets are definitely telegraphing some concern. We're seeing these sharp swings in stocks, unpredictable currency movements, and most importantly, a very specific, very reliable warning signal coming from the bond market.
Now, this one is really important. Usually, you get paid more interest for lending your money for a longer period. Simple, right? But when investors get nervous about a recession, they pile into what they see as safe, long-term government bonds. And this flood of money actually pushes long-term interest rates down, sometimes even below short-term rates. It's called an inverted yield curve, and get this, it has an almost perfect track record of predicting recessions.
So, on top of all these economic and financial signals, we have to layer in some external factors that are just amplifying all the uncertainty.
These are the wild cards. Things like geopolitical conflicts can disrupt trade and cause inflation to spike. Those supply chain vulnerabilities are still a major headache. And the volatility in energy and commodity markets can send shockwaves through the entire global economy. These aren't just background noise, they're potential triggers.
Just take supply chains, for example. When they work smoothly, costs are low, trade is predictable, it's great. But when they get disrupted, it means higher costs for everyone, a lot more uncertainty, and upward pressure on inflation, which makes a central banker's job incredibly difficult.
So,
how do we put all these different pieces together? Let's try to synthesize all these signals into one clear macroeconomic conclusion.
Here's the key takeaway. A potential 2026 recession wouldn't just be some sudden shock out of the blue. It would be the result of a chain reaction, a whole series of interconnected signals, from interest rates to debt to market behavior, all pointing in the same uneasy direction.
The slowdown we're seeing right now is following a familiar pattern. The warning signs are absolutely there for anyone who knows where to look.
And this brings us to the final crucial question. Look, economic cycles are a fact of life. So the real challenge isn't just about spotting the next downturn. It's about what governments, businesses, and really all of us do with that information to prepare for what might be coming.